You bought something for $4. Maybe it was a coffee. Maybe it was a parking meter. Maybe it was one of those small app subscriptions you grabbed on a Tuesday because you needed it for something that week and you told yourself you'd cancel it later. $4. You barely registered it. You might not even remember what it was. And then a few days later, sometimes the same day, you checked your bank account. Not because you were worried. Just because you were in the habit of checking. And there it was. Not $4. Not even $10. $35. You stared at it for a moment. You felt something, not quite anger, not quite panic. Something quieter than that. A kind of low-level confusion that passes quickly because you have other things to think about, and the day keeps moving whether you stop or not. So you moved on. But here's the thing about that moment. The thing most people don't sit with long enough to understand. That $35 didn't come from nowhere. And it wasn't bad luck. And it definitely wasn't random. Let's talk about what actually happened. You had $6 in your checking account when you made that $4 purchase. Or maybe $3.80. Or maybe your direct deposit was scheduled for tomorrow, and the charge cleared today, just a few hours too early. The bank processed the transaction. The balance went negative. And then, automatically, without a phone call or a warning or a moment of human judgment involved anywhere in the sequence, a fee was generated. In most cases, that fee is between $25 and $38. The national average sits right around $35 for a $4 transaction. A charge that might have been for a coffee you finished before you even got back to your car. Now here's the part that doesn't get talked about enough. The fee wasn't triggered by dishonesty. It wasn't triggered by irresponsibility in any moral sense. It was triggered by a timing gap. A structural gap. A gap of maybe a few dollars, sometimes a few hours, between when money was supposed to be there and when the charge arrived. Banks process transactions in batches. Not always in the order they happen. Some institutions, fewer now than before, but still many, reorder transactions to maximize the number of times a balance crosses into negative territory. This isn't a secret. It's been documented in court cases, regulatory filings, consumer protection reports. It's not conspiracy. It's design. And the design is very simple. When a balance is low, the fee is large. When the fee is large, the balance gets lower. And when the balance gets lower, the next small charge is more likely to trigger another fee. You bought $4 worth of something. You paid $35 for the privilege of not quite having enough. That's worth sitting with for a moment. Now let's step back and think about how often this actually happens. For someone living close to the edge of their account, and that's a significant portion of people, not a small one, this isn't an isolated event. The Federal Reserve has reported that a meaningful percentage of American adults couldn't cover a $400 emergency without borrowing or selling something. For those people, a balance dipping below zero isn't an anomaly. It's a recurring weather pattern. One overdraft fee a month is $35. That's $420 a year. But it's rarely one. Studies from the Consumer Financial Protection Bureau found that the people who pay the most overdraft fees are paying them repeatedly, sometimes several times a month, and that the majority of overdraft revenue at major banks is generated by a small subset of customers. Specifically, the customers who are most financially vulnerable. So the math isn't $4 becoming $35 once. The math is $4 becoming $35 becoming part of a pattern that quietly costs hundreds of dollars per year. Money that was never budgeted for. Money that doesn't go toward rent, or groceries, or anything that builds stability. It just evaporates. Silently. Automatically. Repeatedly. And here's what that does psychologically. When costs are unpredictable, the brain stays in a low-grade alert state. You're not panicking. But you're never fully relaxed either. You check your balance more than you probably need to. You feel a faint anxiety when a charge is pending. You do mental math in your head at checkout that has nothing to do with whether you can afford something and everything to do with whether the timing will work out correctly. That is a real cognitive and emotional tax. It doesn't show up on any statement. But it accumulates just like the fees do. And slowly, without anyone naming it, financial stress becomes the background noise of ordinary days. It's worth understanding how this became the way things work. Overdraft protection, the feature that allows your card to process even when your balance is negative, was designed and marketed as a convenience. A safety net. Something the bank was doing for you. And in some circumstances, for some people, it genuinely functions that way. If a critical bill goes through and an overdraft fee is the alternative to a missed payment penalty, the math can still favor the overdraft. But the framing matters. Because when something is called protection, it doesn't feel like a product. It feels like a service. And that framing has allowed a fee structure to exist and persist for decades that generates billions, not millions, billions, in revenue annually for the banking industry, drawn almost entirely from the accounts of people who are already running low. There was a period of regulatory pressure around 2010 when new rules required banks to get explicit opt-in consent before enrolling customers in overdraft coverage for debit card transactions. Many banks responded by reframing the opt-in as a benefit, making the default still weighted toward enrollment, using language that made opting out feel like you were giving something up. Again, no villain here. These are legal business decisions. Legal fee structures. Standard disclosures. Nothing hidden technically. But the design creates a particular kind of outcome. One where the cost of being poor is higher than the cost of being comfortable. Where the margin you don't have costs more than the margin you do. That's not outrage. It's just structure. And once you see the structure, you start relating to it differently. Here's what changes when you understand this clearly. The shame dissolves. Or at least it loosens. One of the quietest and most damaging things about overdraft fees isn't the money. It's the story people tell themselves about the money. That they're bad with finances. That they lack discipline. That if they were just a little more careful, a little more organized, this wouldn't happen to them. But a $4 charge triggering a $35 fee isn't a character flaw. It's a structural event. It happens because of how transaction timing works, how accounts are processed, how fees are designed, and how close to the margin someone is living, which is itself often the result of income, not behavior. When you understand that, the anxiety shifts. It doesn't disappear. But it changes shape. It moves from shame, which is paralyzing, to information, which is workable. And there's another shift that happens too. You start seeing your bank account differently. Not as a number that judges you, but as a system that you're operating within. A system with rules. And if you know the rules, you can start to design around them rather than just reacting to them. Control isn't always about having more money. Sometimes it's about understanding how the money you have is being moved, and why, and where the friction points are. That's a quiet but significant change in how this feels to live through. So what does this actually look like in practice? The first and most direct thing is to look at your bank's overdraft settings specifically. Not assume. Look. Log in, find the section on overdraft coverage, and understand what you're enrolled in and what it's costing you. Some banks now offer overdraft grace periods, or they'll waive the first fee of the year, or they've replaced traditional fees with smaller ones. Some have eliminated them entirely under regulatory and competitive pressure. Credit unions, in particular, tend to have more favorable structures here. If you're enrolled in overdraft coverage for debit transactions and you don't regularly need it as a safety net, opting out means the transaction declines instead of processing and generating a fee. That's a trade-off worth understanding, not just assuming one way is better. The second thing is what some people call a buffer habit. Not a budget in the traditional overwhelming sense. Just a practice of treating a small amount, even $20 or $25, as the floor of your account rather than zero. Not spending below that number. It's a psychological anchor as much as a financial one. It creates a small cushion between normal spending and the zone where fees get triggered. Third, if you're managing tight timing between paychecks and recurring charges, a few minutes spent mapping out when things actually hit your account, versus when you think they do, can prevent the kind of timing gap that turns a $4 charge into a $35 one. This isn't about obsessive tracking. It's about knowing your specific patterns. And finally, if overdraft fees have been recurring for you, it's worth calling your bank. Not to argue, just to ask. Many banks will reverse one fee per year as a courtesy. Some will reverse more. The request takes 3 minutes and it doesn't always work, but when it does, it's $35 back in your account for a phone call. None of this is transformative. None of it requires a dramatic financial overhaul. But small structural adjustments, made calmly and deliberately, reduce the friction. And reducing friction is how you gradually stop losing ground without even realizing it. You bought something for $4. And somewhere in the gap between that moment and the moment you saw $35 on your statement, something happened that had very little to do with you and everything to do with how the system around you is designed to function. That's not a reason to be angry. It's just a reason to know. The people who navigate this well aren't necessarily earning more. They're not living dramatically below their means or following a rigid system that requires constant discipline. They've just taken the time to understand the specific mechanics of their own financial life, the timing, the triggers, the structures, and they've made a few small adjustments that stop the quiet bleed. Financial stress is rarely one catastrophic event. It's usually a slow accumulation of small, invisible leaks. Fees that happen in the background. Patterns that repeat without being named. Costs that feel like bad luck but are actually predictable outcomes of predictable conditions. And the moment you can see the pattern, you're already in a different relationship with it. You're not powerless inside this system. You're just learning where the edges are. And that knowledge, even when it comes late, even when it comes after the $35 has already left your account, that knowledge is still worth having. Not because it fixes everything, but because it's steady. And steady is enough.